tell you to, pay for something or merchandise. We're just trying to give free education on very important topics because we like to provide and share, right? And if you really like the creators and what you're hearing today and you want to engage more, we have free communities. Yes, there's some communities that you can go a little bit further, like Patreon and other services like that too, with me and also with EQ. But again, we're not here to shill that. We're here to give back to the community and demystify things. And we're going to do a series together. It's a really awesome idea that EQ came up with. It's Between Two Candlesticks. Watch that show, Between Two Ferns. So it's all about TA and demystifying it and going a little bit deeper, right? Just a proviso, we can't tell you how to win the lotto tickets. It's not going to guarantee you that you're going to be a Jedi Master of reading every chart, right? There's a process, and it's a battle, and you're going to learn some interesting skills. So I'm Josh, and I'll hand over to EQ for a quick intro.
I appreciate you. Thank you so much for that. My name's EQ. I'm from Alchemy Meta. I've been trading since 2010 originally. Now, that was when I was a senior in high school, so it's been quite a while since then. I didn't get really into the trading scene until around 2014. I started trading Forex heavily, and I got into the crypto scene around 2017. I was one of the unfortunate people that hold an XRP back through the bear run of 2018. Don't worry, I got rid of majority of it before the flare airdrop in February of 2021, so we didn't have to worry with too many issues with that. But I have been in the scene for a while trading. Most of the strategies that I do implement are cross strategies, so there are a lot of things that I learned from other markets. For example, trading Forex, just because the volatility is rather similar to crypto versus like trying to take a stock strategy that, you're basing your guesstimates and estimates on a market that only fluctuates maybe 1%, 2% a day at the most. So with that in mind, I do like to take strategies from a more volatile market and then I move them over into the crypto world just to help everyone get a better idea, because at the end of the day, the Forex market has been around much longer. The market cap is significantly higher. If you actually look at the numbers, the volume on the Forex market on the daily transactional volume is higher than the entire market cap of crypto as a whole. Even when crypto was at its all-time high on like 4 billion, I think it was, 4 trillion, we were still, I think it's like 9 to 10 trillion per day in transactional volume in Forex. So just considering that, there's a lot of room for crypto to grow. Everyone that's here is still really early. Now, if you want to get into crypto, into trading in general, it's best to learn how to trade and learn technical analysis if you want to be the most effective. But with that, there's no easy, cheat code with trading. It's all about practice, putting in the work, putting in the time, figuring out new strategies, knowing that everyone is unique and each trader is going to be unique in their own way. So you're going to have to find strategies that work with your schedule, work with your lifestyle, things like that. If you don't have all day to be trading on a chart, you probably shouldn't be trading scalping. You might want to focus on a 4-hour a daily chart and do more long-term trades. And vice versa, if you are sitting around and you get bored of trying to trade 4-hour charts, then jump in a scalping chart if you're available and you're there all day. So it's really just a matter of practicing and learning these strategies and knowing that, all it takes is just a lot of practice. The more time you put into the charts, the better trader you're going to be overall. And then we'll also be able to give you some other strategies and hints. And that's something that we want to cover, because you can go on YouTube and watch tons of technical analysis videos, but the things that we want to teach on here are things that you won't be able to find on YouTube anywhere. So I do have a video on the crossover strategy, but besides myself, I haven't seen anyone else relate to this strategy, because the two tools that we're using are completely different and they're not correlated. They're not from the same company. They're two completely different TradingView indicators that when you put them together and take the bits of information that they're giving, they're very helpful together. But without sitting there and doing the time and taking the time to find these and put them together, it wouldn't exist. So just know that, what you're going to be learning today, if you try to type it on YouTube, you're not going to be able to find it anywhere. So you're going to be able to have a strategy that most people, you have a competitive advantage over, 98% of people just from having this strategy.
That's awesome. So without further ado, today's topic is the crossover strategy, as you guessed it. And we're obviously going to kick that off first with, I'm sort of the social commentator, the learning journey with you in this voice. So I'll be looking at all of your questions around what is being discussed today in terms of the strategy, understanding TradingView, and some comments that EQ is going to take us through. I'll be looking across the different Discords and also on TikTok and other social media. So if you have a question about what we're talking about, we'll try to interject it as EQ is going through segments of the pitch. We've probably got, I think, 30 minutes worth of talking into this, but there'll be an AMA session and a little bit of a surprise at the end. So without further ado, over to you, EQ. Do you want to tell people basically what is TradingView first? Pretending some people have already seen it, but just a quick 2 minute of how this all works.
Yeah, of course. So tradingview.com, this is going to be my favorite source for charting analysis, even depending on what markets you're trading in or what exchange you're using. In some cases, you can trade directly on TradingView, which is super convenient. Now, the easiest way to think about TradingView is just a home for every chart. It doesn't matter if it's Tesla, Bitcoin, British, or GDP, whatever it might be. You're going to be able to find all these charts in these scenarios. So for example, I'll move this up and you'll be able to see whatever time frame you're looking at. So right now we're looking at the Bitcoin chart on a 3-day for CoinEx. So these are all things you want to keep into consideration. And really, TradingView is just a super easy way to look at charts differently than on an exchange. There's a lot that's going on when you're looking at exchanges. It can be a little noisy. So in order to take that noise away, I like to do my charting separately. I'll do my charting on TradingView. And honestly, I do all of my trades on my phone. So a lot of people will do trades and charting on the computer. I don't like to do it that way. I'll chart on the computer and trade on the phone, just to give myself that little bit of barrier as well. And there's just less noise and congestion overall. So it's all preference, but TradingView is going to be, there's a couple ones like, like MX4 or one of those. There's a couple of different platforms that you can use to do this like technical analysis kind of stuff. TradingView just happens to be the most popular, and they also do have a really nice free version. So that's really what we're going to be going over today. So if I was to create a brand new TradingView account, for example, this is kind of what it would look like when you got to the main page. You would see the general chart and you would see these little volume candles on the bottom. And all of these green candles means that price is moving up. Any red candles you see means that price is moving down. Now within TradingView itself, you can do a whole bunch of changes. I'll move this up a little bit more for now. I just wanted to take out the name so that no one starts to get confused about what we're looking at. But from here, you can change all the time intervals as well, which is super convenient. I like to go from, for example, the weekly chart, when I first start to look at everything, all the way up to the 5-minute chart until I'm actually looking for entries and exits. Now, on top of the time, you can even have your candlesticks. So from here, you have all the versions of like the candlesticks, the lower candles, you can do the lines. If you like the bars, you can change however you want this to look. Whatever is the easiest for your trading style, you can make this work for you. I personally like just candlesticks in general. They give the most information. And on top of all this, you also have a very, very handy tool that is the TradingView Overlays and Oscillators tab. So when you hit that tab, it'll give you a full list of a whole bunch of different indicators and oscillators and scripts and things that you can add just to make your trading a little bit stronger. So for this strategy, the first thing you want to do, just because I do know there are people with a free TradingView account, the first thing you want them to do is hit this little icon in the top left and hide the volume, or just delete the volume in general. That's going to make it so that you have extra space for your 2 free indicators. And then the 2 that you're going to want to use, if you go to search, you want to type in Nada Raya. So Nada Raya, and then you want to go to the Nada Raya Watson Estimator by Lux Algo. This is a free indicator by Lux Algo. They have a lot of really cool resources too. So you add that, and then you'll see right off the bat, I have this little indicator that shows up on the chart. I'll close this one out. And then the second one we're going to want to add is called the linear regression channel. So you can type in linear, and then the name on this is DGTRD, is the actual artist of this indicator itself. So we're going to add this curve and slope to the chart as well. When you do that, now you see that we have these overlays on top of the chart that give you a little more information based on what's going on. It kind of maps out the highs and the lows and things like that. And to make this even easier to read, I do like to go into the settings, and I go to the LinReg by DGT, go into the settings from here. And just to make it a little bit easier to read off the bat, I'll change the color of the LRC to white or like grayish. So you can see this is formerly a red line. Now we're just going to turn this into a gray line to make it a little bit easier to see on the charts. And then right off the beginning, I'll usually take off the slopes as well, or the standard deviation bands, just to make it a little bit easier to see, because it can be kind of clustered. especially for a new trader if you're trying to see all this information. So I'll take off these standard deviation lines, and when I take all of these deviation lines off, you'll notice that all I have now, oh, let me take off the LRL as well. So the LRL is going to be the linear regression. Where is my LRL? Oh, here it is. Linreg 1 off, Linreg 2 off. So now you have these all turned off and your line is gray. It's going to look something similar to this. Very simple. There's no crazy indicators or numbers or anything popping up. It's just a simple two lines. And you'll notice that these two lines are crossing over and under each other. Now, the easiest way to explain these two indicators, just to give you a reference point as to what they read, the Linreg by GDT or DGT is going to be a linear regression. So it's taking linear information, basically taking things that are moving in the same harmonic pattern, versus the Nadaraya, which the Nadaraya is a non-linear version of an indicator. So it does you can look into this a little bit more. It's called a kernel regression. Now, if I was to sit here and talk about it, it would just be way over the majority of people's heads because it is very complicated when you're getting into like how these actual indicators work. But the main thing you want to remember is that the Nadaraya is going to give you non-linear information and the Linreg will give you linear information. And when you're putting the two of those together, it's going to give you a certain bit of information that a lot of these other charts won't give you. So another really, really huge advantage that you get from the crossover strategy is that the strategy itself is going to be a proactive cross. So when you're trading moving averages or you're trading anything like that, if you're trading a golden cross, if you're trading a stochastic, they're all going to be reactive charts, which means that price action will move first and then you'll see the crossover happen. So a lot of times it will not be very effective to trade a moving average on let's say I'm trading a 200 and a 600 day moving average, because those time frames are so long. Most of the time, 98% of the time, you're going to see price move and then you're going to see the crossover happen. And then it'll be like, okay, well, we just had a massive sell-off in price. And we can also attest that because the 200 and 600 crossed bearish, that's the reason why price happened. So that's going to be a reactive versus a proactive, where you can see this line cross. And then this is a 3-day chart that we're looking at. So basically a week later, we start to see the actual weakness in the market, and vice versa. We actually see the crossover here. And it's not until we see the actual crossover of these two indicators that price action wants to follow it. Vice versa, we start to stall out up here. We don't break under until the crossover actually happens. Then price action wants to follow suit. So that's something that's really convenient with this strategy, is that you can plan accordingly because it is going to be a proactive strategy. So it's going to allow you a competitive advantage, just to like get that extra step, knowing that I'm going to spot a lot of these moves and trends before the person next to me, because they're using reactive and I'm using proactive indicators. And if anyone has any questions, please feel free to drop them now. I know I like to go on tangents, so I told Josh before, if he's got to stop me, stop me.
No, that was perfect. We covered a lot there, so there's a few questions, and I guess one thing is we talked about the 3-day there. What sort of time frames these indicators would be ideal for? Is it a 3-day you mentioned there in a comment? Would you bring it down to a 4-hour? Is it diminishing returns where you lose some of the value in the indicator, or a sweet spot? For instance, some work better on a weekly basis for the long-term crossovers, such as we use some terms there, everybody. Golden cross is about the 250 week moving average. So when they cross, you get a death cross, which means bad things, it goes down, and a golden cross, things go up. So that was just a few terms there. But yeah, EQ, first question, what is the ideal time frame when you're looking at these type of proactive indicators?
The best thing about this one is that you can literally use it on any time frame. You can go all the way down to the 5-minute, for example. It might take a second to load, but even on the 5-minute, it's going to be very accurate. You're still getting these crossovers. I can zoom in a little bit more. But even across the board on a 5-minute, just because it is proactive, it's going to register on every time frame. Now, keep in mind that the Nadaraya, this one that has the red and green lines, this is going to be a repainting indicator, which means that this information that it's showing can change as price starts to change, whereas the white line is not a repainting indicator. That's another type of variable that they have that helps a little bit. But yeah, even on the 5-minute, you can see that anytime you get that cross, you'll even have a crossover, and the next thing you know, price will start to follow suit and dump with it. Vice versa, we start to see this crossover happen here, and it's not until a crossover that price actually wants to hold and start to move bullish, and vice versa. We can keep going through this, and pretty much it's not going to happen again. Anything in trading, if anyone tells you that things happen 100% of the time, they're wrong. Don't believe them. It's never 100%. It's a correlation, not causation. So just because some things are correlated doesn't mean it's going to actually cause it. Just because the chart looks extremely bullish, just because I'm looking down here and I see this bullish crossover doesn't mean that it's going to go to the moon every single time. We could see a situation like this where it crosses over and it looks like we're going to go bearish, but there's just so much buying pressure in this area that we do what we call a divergence. This is what a divergence would look like on the crossover strategy, where you start to pull bearish, but notice that the color on this line is not changing, where vice in these other areas you start to see it change into a red line. That's going to be a sign that there probably is really not that much weakness here as you would think. And this would be a good time because you're looking at the 5-minute chart. Maybe I'd want to zoom out a little bit and go to like the hourly and kind of see what's going on the hourly crossover and being able to match them as confluences. Because if you want to be a really strong trader, it really comes down to being able to take information from multiple time frames. So from an hour, from a 30-minute, from a 1 hour, 4 hour, daily and weekly, take all the information you have across the board and then create hypothetical situations. If price was to go to here, what would happen? If price was to push to here, what would happen? That's something that we do talk about in our group as well. Just to talk about it real quick is we like to play 60-40 games. So what that means is that I'm never going to swing too bullish or too bearish in one direction. I'm always going to play a 50-50 mindset. And then depending on where the technicals are pushing me, so if the technicals, or if we're in a bearish crossover, for example, I'll lean my strategy 60% bearish, 40% bullish. Because that doesn't mean that because everything is bearish that we don't get to this point right here at 31,000, for example, and just start to moon. No one knows what's going to happen in price. So it's just really important to, one, wait for trades to come to you. And then two, when it comes to that area, then you can start to gauge what's moving. Because once you get to these highly volatile areas, let's say like a critical support or a critical resistance, if that support holds, then yeah, your play is going to be very strong. But if that support breaks, then you're going to have a very explosive downtrend because you're breaking a critical support. So with that in mind, if you are only looking for a bullish move, now you're stuck and you're going to get liquidated in your trades and you don't know what to do because you weren't planning for it. Versus if you go into every trade planning your bull and your bear entries and exits, you're going to be that much more successful because you'll know that if there is a swing in price or something weird starts to happen or you catch some crazy volatility, for example, right here, like if I'm watching this crossover and I see this go bullish and I see that the line's crossing over, but there's no green coming into this area right now, we're still staying very, very red. This could be a nice play for a divergence. So what I'm doing is I'm watching to see if this line crosses down. Now, most people, if you were impatient and you were just playing one-sided, you might be only looking for a long in this position because you saw the crossover happen. So you enter a long down here, and the next thing you know, if you didn't close in the next 20 minutes on this chart, for example, you would have seen a huge sell-off and you would have lost that money. So it's always important to trade both sides and just know that whenever you're going into any trade, that you're never going to go 100%. So, account for loss and just be ready for whatever can happen next with price action.
So that's a really good comment. And obviously the time frame we're looking at here is very short, everyone, 5 minutes. So someone that, remember the time frame, just as a guide, if you're looking at smaller time frames, you're more active on the chart. You're not walking away in 5-10 minutes, right? As you change time to broader, you're having a longer term strategy. So you're not going to be as active on it. So at the intro of the video, we said, depending on the time frame you're setting, whether you're spending a day doing this, right, getting used to it. And by the way, everyone, you can actually pretend, right? You can actually create there are some places where you get test accounts, so you can do test account versions of it, or you can just make some assumptions by yourself and put a line on the chart, right? But what we're talking about now is the risks associated to leverage. We do talk about, normally on my channel, more about the long-term researcher and the spot holder, right? Buy and hold and sell when you want to take profits. But when you use leverage, right, you can play the ups and the downs, but the risk is liquidation. And an interesting candle. You can see it just to the left of EQ's screen. Do you see how the candle wicks down and then wicks back up, red and then green? If you were extremely long in that position, right, I like to nickname them scam wicks. They're not scam wicks, everybody, but these things can happen, right? On the smaller time frames, you can have volatility drops. So if you're playing shorter time frames, remember your liquidation level, if you're longing, could have got liquidated in that big wick down, depending on how high you go. So when you think about your risk appetite with leverage, yes, the bells and whistles and 100x looks nice, but that would be a very good candle that would have wicked you out, right? So most people don't generally 100x. I think there's some platforms that do 400x, right? They're extremely risky, right? What would you say, EQ, it's a comment that came up, and then also about some charts. What is the typical person starting in leverage? What is a good level in terms of risk where they start 2x, 5x, 10x? What is that factor?
I would recommend for anyone that's new, one, to practice with very, very, very low risk just off the bat, because there are a lot of different factors that go into leverage, like if you're running cross margin, if you're running isolated margin, if you're doing a market buy, if you're doing a limit buy. There's so many different versions, but in terms of leverage itself, I never recommend any new person go over 5x. I highly recommend starting at 2x, 3x. You don't need that much leverage in crypto. You got to remember, like if you have $1,000 that you're in and you do a 2x, you've now created $2,000. So now everything that you're doing is going to be twice the amount of value that you were originally making. So that's where, like what Josh was just talking about with the 100x's, 200x's, all of that is just driven by greed, and they're trapped by the exchanges to bait you to want to buy those positions because they know that they're going to make the most money off of people getting liquidated. Because instead of just getting a transactional fee every time you trade spot, now as the exchange, I get to liquidate your money and take all your money, and whatever I don't pay off from the differential from the loan, I get to keep. So exchanges make a lot of that's the most of their money is from liquidations. So just keep that in mind, is that you're playing the house. This is like a casino. I don't like to call it that, but when you're in leverage, it's the same concept. You're playing against the house. There's house rules. That's even why if you look at a Bitcoin chart versus if you ever look at Bitcoin perp, that just means it's the futures leverage chart on Bitcoin, and the prices are always different. Why? It's because they play a house percentage. So basically what it does is that if the market thinks that there's more bullish potential, they're going to automatically put your entries higher so that you start at a negative percentage. So if let's say I'm trading Bitcoin right now and I see that on the chart we're at 30,000 on the regular chart, and on leverage we're at 30.2 thousand. That would mean that the market thinks that there's a chance that there's going to be a bearish pullback, so they put a higher price for you to enter on leverage with the intention that you're going to have to catch a longer move on the back end. So they have their own little version of being a dealer, and that's also why you can take advantage of arbitrage situations. Arbitrage is just a price differential between exchanges or different trading styles. So if I'm an arbitrage bot, I can take advantage of the price differential between a leverage chart and a spot trading chart, and being able to buy those differences up without anyone even noticing, because it's just happening in the back. So yeah, I would definitely recommend not going anywhere over 5x as a new trader. And honestly, until you get like a really good hang of it, I wouldn't go over 3x.
That's really solid grounding for this. And it's interesting you brought up arbitrage. We're sneaking in extra terms there. We do apologize. We know we're only starting our journey. But Sam Bankman-Fried, the owner of FTX, he made all his money from being an arbitrage trader and creating bots. And he decided to make an exchange. That's how he became one of the largest billionaires, right? So, and he was a very young person doing that in his parents' house, and now I'm sure he buys many houses for his parents. But everyone, you might have noticed we're jumping straight into the element of looking at the charts and looking at a very interesting strategy of predictive modeling rather than lagging indicators. And why did we do that? Why aren't we chucking up a chart of this is not sponsored when I say this, but everyone knows what Bybit is. It's a leverage exchange, right? And a lot of influencers follow you there. We're not here to do that. The reason why day one is that this is how you get into Bybit and this is how you do leverage is how do you actually even do that? We will do a live session where we'll put a little bit of money on a fresh account on Bybit, and we'll put in a small amount for fun to show you live about how it all works and to set up a trade. But that's going to come later, because before you even get to that box to understand some of the complexities we talked about, whether you want to do spot, whether you want to do leverage, what is that factor that you're leveraging, and also that liquidation. There's a few other things you need to learn along the way, and jumping into using the platform should be the end of that journey. And I know it's a little bit so boring, but we're not here to shield, we're not here to promote, and we're also here to give you a bit of education on risk, and we're just being honest about the risks to this. And leverage has a lot more risks because you get this thing called liquidation. But just a little bit of grounding for knowledge. In crypto, unlike the financial markets, it's overcapitalized. What does that mean in English? You cannot, playing leverage, lose any more than the money that you put onto that exchange. However, in some instances, if you need more capital, we use this term called isolated, or we use the other terms in terms of working with your wider bag, right? So if you had Ethereum here but no Bitcoin, you could do isolated for just the amount of USDT that you want to put down, or you could leverage other cryptos into your bag to get even more leverage. But the most you can ever lose is the most you have on that exchange. You don't get a margin loan debt like in the real financial world if you had a margin loan. And then liquidation becomes margin calls. It's all the same thing, right? But the most you could ever lose at risk is the capital you put on the exchange. And why do people get sucked into 100x? Things like Bybit say, if you join our program, for every $1,000 you put on for the first 2,000, we'll give you an extra $2,000. And then you think, oh, well, that's just free money. Well, what's this 100x? That looks cool. And then your account gets wiped. And that sadly is a very common thing about anyone that goes to those exchanges. So be very, very careful. Introductory free USDT. They do that because it adds to the greed factor. And remember, in this game, it is a blood sport. For every long, there is a short, and for every short, there is a long, right? And in the middle is the war of it, and that's where you get this battle of the bulls and the bears. But stick with this series, everybody. We're going to be capturing many things, and I know we had a few questions pop in, and I'll bring them up for EQ. But one of them was from Scott. There's a few about information about the charts and indicators we've spoken about today. How do we get around saving all these different indicators for different strategies? So with TradingView, I think you get 2 free. We're using 2 indicators here in the free version to show you how to do it for free. You can add certain other things such as RSI and volume. Once you add more than 2 indicators, TradingView will make you pay a subscription. I think it's $5 to $10 a month. It is very small, but if you're serious in it, most people pay for TradingView. We will see if we can reach out to TradingView to see if we can create some sort of promo code or something. Again, we're not here to make money off that, but sometimes if we talk about TradingView, they give a discount for it. I don't have one of those codes, unfortunately, but we'll look into that. But if you do want to have, I guess, profiles that you can flick between, I think it's $5 to $10. Maybe you can remind me, EQ, on the cost of that. It's very minimal, but you can make use of that small fee to use that. So one of the barriers to this is as you get more technical with your TA, in some instances people use a predictive modeling, larger scale modeling and other oscillators as well. And as you get more indicators, then unfortunately you do have to pay for a service. But we'll try our best to show different sort of models you can flick through. But it's a convenience thing, I think. Anything to add on that, EQ?
Yeah, definitely a convenience thing. I know they range on the price. It goes up to like $60. Like, for example, I run one of those. So if you look at my charts, I run a ton of different oscillators. So it's just a really quick way without going too crazy in all of these. These are just here so I can get a better idea of what's going on in the market and add percentage probability to my trades. So if I know that my crossover strategy, for example, has a 60% accuracy, just hypothetically speaking, and each one of these I use, I might be able to add an additional 5% on that call. So now I went from a 60% entry. If I get more confluences, I could bump this up potentially to a 75% accurate move just by adding these extra confluences and just scanning the market and just adding a couple more benefits. I'll also look into seeing what I can do about that TradingView discount as well. See, we're getting a nice little test. Yeah. I'm looking at the 5 minute on the spot, and we're getting a nice little test currently. So we might be able to see a nice little move here and test the crossover live, which is always fun.
That's really awesome. And again, everyone, we're not here to sell TradingView. We're not paid or sponsored by them, but these are just good questions and to give you some feedback on that. And good question though, Tim. So what we'll do at the end of this stream is we'll put some notes in our Discord. They're free Discords, everybody, that you can join about what we covered today in terms of the crossover strategy. I will put a couple notes on what those indicators were that you can search, because it's all there in TradingView, and you'll see these replays on social medias as well, but we'll try and get some text for you to make it easier, and we'll have it in a nice series. So don't worry if you're furiously writing things down. Enjoy looking at the chart for the view you have now, and you can watch this series on social media. So we'll have that out for you. So don't worry if you've missed it. And I guess probably another interesting thing is just the start of the journey. There's many things to talk about, such as, we're using a lot of terms here like oscillators, volume, overlays, and we're going to give some definitions of what they are and what they can do. And I know there was a comment about Bollinger Bands, and there was another comment there as well around volume. So this is predictive modeling, where it takes different types of momentum, which was described before, putting it into two crossover strategies, looking at two different indicators that tell like things and momentum. And if they both add up to the same story, it gives you a possibility in the future, not guaranteed, right? Bollinger Band and relative strength index. So I'll go back a step. Everything that we talk about, like the crossover strategy, the indicators have a purpose, right? Bollinger Band and the relative strength index basically give you a hint when something's oversold or overbought, right? And that can give you an idea of, oh, okay, maybe I should take profits on this time frame, or maybe this is a time to buy. Now, that view or take profits and buy can also change if you're a spot person or a leverage person, because a leverage person could technically take profits on the way up or the way down. The spot person obviously can only do it in the normal direction of the movement of flow, right? That's a separate indicator to this. And then there's some other like oscillators, which is all those four things you saw in EQ's charts. And when he's saying confluences, he's saying adding to the percentage of what it's telling me. So there are two factors for RSI and Bollinger Bands. They both can tell you something's running hot. RSIs usually gives a little bit more gas, if I can use that term, and can be a little bit more accurate. But generally speaking, when they tell the same story, that gives like a 60-70% factor of what could happen next. So just like you're seeing in the crossover, we got a 60-40 rule here, and those extra layers underneath those oscillators add extra 5%. But just remember, everybody, obviously this doesn't perfectly tell 100%, or the system would be broken and everyone would be billionaires, right? There is obviously the risk of FUD, panic, fear, emotion, and of course volume can come out in anywhere. Like an example would be if a spot ETF by the Fed was announced to be approved tomorrow or right now, I guarantee you any color here would just change, right? So that's always an opportunity and a risk to consider. But maybe, EQ, do you want to talk about some of the oscillators and how you describe that to someone new about how to look between all of them?
Yeah, definitely. I know there was a question about how to save them, so I just want to do that real quick. If you did want to save these indicators, let's say I type in Nadaraya and I wanted to make sure that I could get easy access to this later. There's these little stars next to it that you can click, and this will add it to your favorites. So then when you go to your favorites tab, you'll be able to find all of the indicators that you saved. So I can post this list later in the Discord too. These are all indicators that I switch in and out. Some are Gartley, some are RSI, some are KDJs, some are DSIs, some are, fast stochastics, slow stochastics, ADXs, commodity channels. There's so many different types of indicators and oscillators. So I switch them out, and I just like to find different combinations to use, just because it can be a little confusing if you have too many on the chart at once. Now, with these with these oscillators, the big difference between them is if you're using one like this guy, for example, this is going to be an RSI combination. So this like fast line squiggly is going to be a fast stochastic, versus this little line in the middle that's changing colors is going to be an RSI. So these are just giving you two different bits of information. Now, the way that you can read a lot of these charts, if you see one that has a range, let's say at 80, which is the top, and then 20, which is the bottom, these are going to be indicators that are reading overbought and oversold. So anything on top of this line is going to be overbought. Anything down here is going to be oversold. Now, when you're playing the RSI game, there's also a 50 point. That 50 point is going to be able to dictate whether you're bearish or bullish. So there's two different forms on it. So when you're looking at these, so for example, your MACD, the biggest strength of the MACD is going to be when you're crossing the zero, aka when you're crossing from bearish to bullish and vice versa. Whereas this guy right here is going to be a money flow index. This kind of helps gauge overall volume flowing into the market. This doesn't have a middle point. So the focus on this chart is just to tell you whether we're overbought or oversold. So You want to use these things again, like I just love to use the word confluence because really all it means is just putting things together to just give yourself a better opportunity. So if I'm looking at a daily chart and I'm looking at an hourly chart, and both of those charts are showing me that the indicators are overbought and that the RSIs are overbought and that there's way too much flow on the RSI right now in the MACD, and at the same time your volume is starting to decrease, that would give me a sign of, okay, volume's leaving, we're overbought, chances are there's a lot of weakness in the market, so I might want to look for a short in this opportunity because I'm seeing across multiple time frames that that's happening. So like another really easy way to explain this is if I'm trading the hourly, right now I'm watching the hourly and I see this support hold that's forming on the crossover strat, or sorry, on the daily. This is a daily chart. We see this crossover that's forming and holding bullish right now. We have the green not a riot that popped up and everything like that. So I know long term we're looking bullish. Now, I really do want to see this guy down here, which is volume flow, start to pick up, because without the volume flow coming in, that would signal that there's no money flowing in, and without that money flowing in, price won't move up. Because I'm just going to go back to this one little point, is the only reason price moves is based on supply and demand on exchanges. So if there's a lot of people selling positions in Bitcoin and no one is buying Bitcoin, that means that there's more supply of Bitcoin on the exchanges, which it decreases the demand and which will decrease the price of Bitcoin, and vice versa. If there's a lot of people buying and no one is selling Bitcoin, the supply on the exchanges is low, which makes the demand high, which in return increases the price on Bitcoin. So everything that you're watching is a direct reflection of whether the supply is high or the demand is high. So right now we're starting to see the demand is flatlined, it's there, but at the moment there's not too many people buying. So I wouldn't expect price to go up, aka demand to go up, because there's really no one on here buying right now. Same with money flow. No one's buying anything right now. So until I start to see that on a longer term, that is, so for example, I haven't called a bottom yet. If anyone that follows me, I have yet to say we're at a bottom by any point, because all of my long-term volume readers are all telling me that the volume isn't showing up quite yet. It's there, it's kind of showing up, but if you zoom out and you see where the volume's been before, there's a way more volume in this whole bull run. Even from before we started the bull run, we were on top of the zero, which is the bullish side of the VFI, which is volume flow. And through the entire bull run, we stayed bullish. It wasn't until we got into this first little dip that we tested bearish on the VFI. And then since November 28th, November 30th, we've been bearish the whole time on the VFI. So until I start to see this break back up into bullish, I wouldn't be confirmed long term that there is actually volume flowing in at the moment. And since we're looking at the daily right now, I do want to show you how this crossover would work and how you would have saved money. So for example, if you were looking back at this chart in November and October, you can see we would have had this first massive spike in October 21st. By October 26th, we were already crossing bearish. And on November 8th, 9th, we were testing this LRC as a resistance. Now this right here, this little pinpoint top is what I would call my confirmations when I'm using this strategy. So I would go within this general area right here. This is going to be my confirmation test, because we crossed bearish and then we hit a resistance on the LRC line. So this red and green line will be called the Nadaraya, and this white line will be called the LRC, and vice versa. When you're looking for bullish plays, let's say we have a crossover down here, we see the cross. It isn't until price is down here hitting the support at the LRC and then another support down here where we get this double bottom. These would be your support confirmations, because you already broke and then you're holding this trend long term to have price push up. Vice versa, we can keep going down this list. You know, you have your crossover right here and then you have your confirmation up here. So a lot of times, just because you're getting the cross doesn't mean it's automatically going to dump. A lot of times you will get this retest, and this will be the best entry overall because you're getting that confirmation. Now, on the other side of it, when you're looking at this little spot right here, you'll notice that a crossover happens, but price action continued to move down. Now, one of the main things that really is awesome with this strategy that works really well is it'll help you with fake outs too. So if you're watching this and you thought we were going to continue to sell off, your factor that would have kept you from thinking that this was a true selling position to go down to 30,000 is because your crossover is bullish. Anytime you have a crossover happen and price action is going the opposite direction, that is a sign of a fake out. So we do see something like that here where we see these massive candles coming down. It looks like there's going to be a lot of volume. And then right here, we see a lower candle wick that kind of pops out of this zone. But at the same time, your crossover is bullish. So these candles down here would all be fantastic sniper entries, for example, because all of these would be areas where you tend to have higher fake outs because your trend line is showing bullish. Meanwhile, your price action is faking into bearish. So you have the same thing down here. You have the crossover that happened. I'll move this circle. This right here would have been a fake out because you had the cross. Price looked like it was going to continue to sell off, but it was just another area for people to add their liquidity before the true pump. Vice versa, you see this cross happen over here, and there is like a little bit of fake out right before. That would have helped you out to gauge that more than likely this was a fake out and that we weren't actually going to continue to push up really strong just because we're getting the bearish crossover. And then again, you have your confirmation up here. If this could have broken up hypothetically if it really wanted to. We could have seen price push up to 71.4. There's nothing that would have said that that couldn't have happened, especially with an upper candle wick. But anything in this general range from up to, like, let's say anything just up in this general zone would have been a great area to look for a final confirmation of a short. Anything that you would have gotten up here would have been considered a sniper entry. And that's something that I would have gone from the daily all the way to the 5-minute and tried to find a little location on the 5-minute chart to see if I could spot this weakness and try to catch this upper candle wick at the top.
Amazing. I like your word of sniper. I as you probably realized from some people on the JTC stream, I talk about trying to snipe the bottoms. You'll never get the perfect bottom, everybody, but in those days that he's circling, those extreme days of those wick downs, I was buying on those days. Didn't quite do too many leverage plays at the time because I was working on some other projects, but let me tell you about the psychology of these days, everyone. They'll all be out there. Bitcoin's going to 10K, 7K, crypto's dead, and always on these days when the market's at its worst, the FUD, you hear about this word fear, uncertainty, and doubt, right? There are good articles that can give you, like, that might cause more shakiness to maybe alter the way the market's going, but no one knows the truth to how that shocks it. But generally speaking, on these days, a lot of people are scared and are selling. And then conversely, on those top parts, the hard part, everyone's greedy and not taking profits, right? And it's about taking that emotion away from it, right? TA can really help you with looking at trends and confirmations, but ultimately there's an emotional part of all of this because it's really easy when we're all looking at Bitcoin at nice time frames in the history and we could have did this, we could have did that, right? But when you're in the chair and the risk's on you, then it becomes very, very different, right? So hopefully through this series we can demystify charts, help you with some things. Again, we're not here, we're condoning you thinking about going 100x leverage, going nuts, and putting your life savings on things. That's not what this is about. It's about education, demystifying, and finding ways you can talk about things. One interesting comment that happened on another stream before is why we talk about Bitcoin so much. So we're focusing a little bit more on Bitcoin because it is the market indicator of such. What happens with the bullishness and the bearishness of Bitcoin rattles the market. Bitcoin cools off sometimes, has fake outs, and an alts run. But when things are really scared, every person, most people with their salt, I don't mean that to insult some people, will stop looking at their bag if they're not holding Bitcoin and look at what's going on with Bitcoin, right? And in times like this, some of this can demystify. And as we go through the series, yes, it is recorded. It'll be on social media's various accounts soon. Nobody user, so that's no problem. We're already just taking lesson one about an interesting crossover strategy. There's so many more things we're going to be talking about through this series and topics. We will, and we haven't got all the episodes lined up. We'll react to how people like this session and comments as well. But as we go between two candlesticks, the series called everyone, people that have dropped in recently, we're going to talk about MACD. That's probably another whole discussion about convergence, divergence, because we mentioned a lot of it here, right? The meaning, you probably heard this before, it's a bearish divergence. What does that mean? It's going up, but no, all the indicators say it's about to drop. Or a bullish divergence, that's the one that everyone's waiting for Bitcoin, right? Everything's looking bleak, but then pops. So we'll talk about that in another lesson in more detail. And yes, there will be a discussion about different views on different patterns, because you see that a lot with I won't use the word influencers, but people that talk about trading, they're like, that's a bear flag, that's a this. And maybe some people you watch just talk about patterns and don't really talk about other indicators like volume. So all of these things together can give you different feelings and stories. It's never 100%. Don't believe anyone that tells you that. And this is just a way to demystify it. But we've nailed about 30 minutes worth of chat. I think we nailed all of the things about basic explanation of the indicators and walkthrough. We'll open up for some more questions live in the audience while we've got EQ here as well. And don't worry, everyone. If you leave the stream afterwards, please join our Discords. It's all free. And if you want to learn more about what we do in terms of other things we create and other things, it's all in our Discords as well. So let's pop in there for some questions. Anything that you had about the two strategies today, the crossover strategy, what you've heard, questions on the spot. Any on your side, EQ?
I don't see any on my side, no questions, but I'm happy that you took the words out of my mouth about the divergence, because that's definitely one that I want to be doing within the next couple sessions. I would call myself personally a divergence and volume trader first and foremost. Those are like my two focuses. So yeah, it gets me excited when I hear the word divergence. And like, there's just so many different. I always tell people in our group too, if there's anything that you can memorize and remember off the bat, especially as a swing trader, if you're trying to catch lows and highs, learn about divergences, learn the difference between hidden and irregular, those types of things. We could do a quick little run through too. If we don't have any questions, I could just do a quick like 1, 2, 3 divergence.
We could do a sneak peek of that. I'll just check for any more questions on the other stream as well. And don't worry, everyone, if you didn't catch the different types of metrics and how to get the charts up, we'll put like a bit of a couple of words together on both Discords, so it's all there written for you, so you don't miss out on anything. And we'll go into a sneak peek of MACD. You'll hear about the MACD, so when everyone's not talking about that, that's convergence, divergence, in terms of looking at volume flow and indicators, so we will do that as well. JC, not JTC, how do you go about picking a suitable coin to trade? That's a fantastic question. I think that's another discussion in itself. No one can tell you the best thing, and I was going to mention something about that before, but if you look at different types of, we'll talk them crypto projects instead of coin, right? Depending on the size of the market cap, how much money is in circulation in the project, right? Bitcoin's number one. So that means as you get to the larger caps, I would say using TA becomes simpler insofar as the shocks and the movements can really be articulated. As you move outside the risk curve, because generally speaking, the lower the market cap, the more upside and the more volatility. That's because there's not much money flowing into it. So when we talk about the example of what if the US Fed announced tomorrow a spot ETF for Bitcoin, that would blow Bitcoin up, even though it is the number one market cap. As you go out to smaller market caps, the volatility of how money flow can pump it can be quite extreme, right? Like we looked at Gala, I think a day ago, it like popped at 100% or something like that. Bitcoin could, in theory, with enough volume flow, pop at 100%, but very unlikely. We've seen how Bitcoin's changed with momentum and volume, right? So as you think about what type of crypto you're looking into, note that the amount of money circulating in it will also dictate of how hard it can pop and also how hard it can drop. I'm not sure if you want to comment on that, EQ, before we jump into the MACD demo.
Yeah, volume is everything for me, and that's probably my main tool that I use to find trades in general, is go through the 4-hour, daily, 1 hours, even the 5 minutes, and just gauge overall volume, because volume will tell you exactly what's happening. You know, the best trades happen when price is moving sideways and volume is moving up for a long position, and vice versa. If you're looking for a really good short position, you want like a consolidation range, maybe ranging a little bit in an uptrend, like a bearish flag, for example, and next thing you know, it drops down because the volume has been decreasing. So volume is usually my first telltale sign of whether I would even waste my time looking at a project or not, just for that time being, because there's 10,000 crypto projects. So the odds of you finding the one that's going to go up 50-60% that day is very, very small. It's a needle in a haystack. So the best way to improve those odds are to just gauge and find, you know, for me personally, I have I think 35 or 40 projects that I can comfortably trade at this point. So I know basically what their charts are doing, how they move. especially with Bitcoin. If you're in our Discord group, there's sometimes that I can call some things like right down to the dollar amount, because I've been watching the Bitcoin chart for so long that I've already learned how it likes to move. And when it does certain things, or, certain areas where it likes to fake people out, or, it's just a matter of being comfortable with those charts and knowing how they move, because the Bitcoin chart will move different than Ethereum, which is going to move a little bit different than Aave, which is going to move a little bit different than Polkadot, which is going to move a little bit different than Quant, so like as you go on, like Josh was saying, the higher the volatility, that means the lower the market cap. And so at the same time, the lower the market cap, the more you can lose if things start to drop. When you're in a crowd market and Bitcoin drops 5%, you can see some of these altcoins bleed 20, 25, 30% that day, and vice versa.
Absolutely. A crab market means it's going sideways, not always up or down, but just within the band. So if we look at what happened with Bitcoin between 28K to 31K for the last 3 weeks, we're crabbing at the moment, right? That's what we mean when we saying these. So as we go along, these euphemisms that you're hearing, like crab, bullish, going up, bearish, we'll demystify it. But hopefully this is all making sense, and I think we're up to date with all the questions. So let's give a little quick sneak peek on what is MACD and a 3-point strategy. And don't worry, everyone, this is going to be like a whole nother discussion. So over to you, EQ.
Oh yeah, let's do it. So on the right off the bat, I like to use the MACD, and I also use MFI, KDJ, and VFI, all to read divergences. They all do really well at reading divergences. So if we're looking at Bitcoin at this all-time high from October 20th to November 11th, you can see that price action made higher highs. So theoretically, if I didn't have the crossover on and I'm looking like this, it looks like Bitcoin could have gone to the moon. It looks like we broke this all-time high. We're a moonshot right now. What's going to happen next? Everyone's going to make money. We're going to $100,000. It's game over. Everyone add your bags. We're leaving. But if you actually look down at the oscillators, everything is in a downtrend. So your MACD is in a downtrend. Your MFI is in a downtrend. Your KDJ is in a downtrend. Your volume flow is in a downtrend. Even your RSI is in a downtrend. All those things are going to tell you that you're looking at a regular bearish divergence. Now, this is what my cheat sheet looks like, and this is kind of something I use all the time. So right off the bat, if I put this up to here, you can see that on your regular bearish divergence, you have price action going up, and then you have your volume indicators and oscillators going down. So with that in mind, when I'm watching this, I can see on a long-term Bitcoin daily chart that there's definitely a bearish divergence, and what happens next, you get a lower high, and then we get into the true sell-off. And that's really what starts the trend. Now, when you're looking at divergences, the regular divergence is going to be usually what you see at the end of a long-term trend, and it signals a reversal pattern. And then if you see a hidden divergence, that means that you're looking at a potential continuation. So something like this right here would be considered a hidden bearish divergence, because price looked like it was going to pull back up, and then we continued our downtrend. So when you're seeing these hidden divergences, that's going to be a sign of continuation and that the pattern is going to continue to move. When you're looking at a regular divergence, that means that you're more than likely at the end of a long-term trend, and price might start to change. And you always have to keep into consideration that when you do hit these divergences, more than likely price will go sideways first before changing its true direction.
Brilliant. And just some of the, I know this is probably a lot, we're jumping into the next sneak peek, but putting away the word divergence, if you think about it, you hear about this term that buyers are being exhausted, i.e. we're getting high highs, but if you look at the volume, the money going in, it's not as much, right? So it's a little bit of supply issue causing the price rise. And that's where all this whole term about the money flow, the momentum is very important. So the old saying, follow the money, has many meanings, not just in trading, but also in investing, right? And this is some of all that more technical things of how you can follow the flow of money, which is very, very important. We track that on a macro perspective weekly when we do our TIA Tuesdays, talking about what are the massive inflows, but just because there's inflows and outflows in a market doesn't mean, because there's positive inflows net week, Bitcoin's price might be going up, because it's money that is circulating between those sort of activities. If you think about a spot person that hodls their Bitcoin compared to the leverage players, because when people get liquidated, that also can cause all sorts of other things, shorting coming down even harder. and other things getting more bullish depending on what's being liquidated. Shorts get liquidated really hard. We have a short squeeze, we go up. Longs get liquidated, no one likes that one. We go all the way down, right? And that has a momentum in the market, and all of that is really, really interconnected. But don't worry, everyone, this MACD part is a whole conversation in itself, and then talking about how to spot a divergence, how to spot a hidden divergence, a little bit harder at the time, as alluded by EQ. If you were there at the time, it's a bit of a risk. Is it an actual hidden divergence? Because at the time you might just see it, and that's the risk of the leverage play. I'm going to risk it, and I'll short it. So the principle of the leverage player, it's not like the spot person accumulating Bitcoin over a year trying to get the lowest possible prices and selling in 10 years, right? The leverage player takes on risk that everything is a play. I'm using the word play. I'm going to long Bitcoin here, and I might lose that one. But maybe I'll win the next 3 shorts, then I'll lose that long. And when we use the word lose, there's different levels of lose, and we'll talk about that much later in the piece in terms of liquidation levels and all this sort of stuff as well. But stick with us. We've got an awesome journey across. I don't see any more questions, but just a quick announcement. If you didn't know, we also do projects as well. So maybe, EQ, do you want to talk about the project that you're doing?
Metamystic Superheroes. That is our NFT project that is built on Polygon Matic. We have direct website minting and staking. The mint dates are going to be announced and released once we hit 1,000 members in our Discord group. So anyone that wants to come join us, you can get an alpha roll. If you get the alpha roll, you basically get pre-mint access. You'll be able to get a mint probably a month earlier than everyone else will be able to. So yeah, it's going to be a really fun project. That's been a project with my girlfriend and I. She's the artist. She is an absolute killer with the art, and I would say I'm more so the myself and Matrick. I'd see Matt is in the chat as well. We handle more of like the strategy side, the tokenomics of everything, the staking rewards, all of that kind of, the calculative stuff. But yeah, that's going to be a really, really amazing project, and that's why we're happy that we have direct minting on the website, because you don't have to worry about the OpenSea gas fees with like Poly Wrapped ETH if anyone's ever dealt with Polygon Matic.
Yeah, that's absolutely true. And again, everyone, we're not here to shill that. We're just introducing something. And why did we introduce that particular topic? Because we're going to do a whitelist giveaway. So I'm going to be running that in my Discord. It's very easy. Join the Discord, hit the party symbol. It's not up yet. Don't jump in there just yet. Give me some time to put it up there. And there'll be some whitelist positions to win. And it's as simple as that. Click a button. And conversely, I'll be also giving away some whitelist positions for Keep Cats in Alchemy Meta's Discord as well. So you just have to log in and hit that party sign. Nothing nefarious, everybody. Again, that's just some other ways you can interact. If you want more information about the projects, they are in our Discord as well. So that's just a bit of a celebration to kick this off. But look, the rest of the series is going to look really, really great. We've got a few topics lined up. If you really enjoyed this and you want to take your trading to the next level, or you're curious about what goes on with Alchemy Meta, I highly recommend you check it out. Whilst the Josh Talks Crypto KitKat's Discord has one channel on TA, Alchemy Meta has many channels on TA, different types of aspects of inferences and different trading strategies. So as you see the differences there, we're both here also coming from educated background, free to enter and ways to connect, and we're both in our Discord openly, so you can talk to us. Remember, talk to us publicly. If someone's pretending to be us, we would never get you on a private chat or take Bitcoin or crypto from you. That's not what we're here about. So if that happens, be very, very careful. And we've got moderators, so hopefully you'll be able to be safe in that. But a big thanks from me and everyone from the Josh Talks Crypto side that comes into our stream. And big thank you to EQ for doing a lot of hosting and going through all of your knowledge.
Yeah, of course. I appreciate you. Thanks for hosting us. Happy to be able to teach everyone. Make sure to stick around and follow us and join our Discord groups. We're more than likely going to end up, we have so much content for TA stuff that we can go through probably 30 plus episodes of Between Two Candlesticks. So if you want to keep learning more, if you're interested in learning more, anything like that, go join the groups. Again, appreciate you, Josh. Thank you so much for everything. And yeah, hopefully everyone has an amazing day.
Absolutely, everyone. Go kill it. Take care, everybody. Thanks, EQ. We're going to close down TikToks now. Have a great day, everybody.
Appreciate you. Have a good one.
Bye.